Okay.
We're having some technical problems here. Let's see. Why is this echoing? This is crazy. All right, testing, testing. And Serena's frozen. Okay. Let's check over here. All right, well, welcome everybody to Tax Sherpa office hours. Crypto Reaper says sounds good. So hopefully this is working. My computer's locking up here. Serena, are you still with us? I think my Zoom froze. So the trouble with having Serena on Zoom and then streaming out to the other side is that my computer is not real thrilled. Oh, I got movement on Zoom. All right, so while we're working on that, our technical difficulties. Yeah, so this is office hours Q&A, where how well, actually nothing specific, but tax, business, life, meaning of life. Excuse me. And the basically it's just a collection of questions we get over the weeks. We do these every other week at 6 p.m. here, Eastern time at least. And we collect all the questions that have come in over the past couple of weeks, and then we have the live streaming. We're live on LinkedIn, we're live on YouTube, and for this stream, I think that's it. Oh no, we're also live on Facebook. So if you're in one of those three places, you can chat, and then we have the restream that picks up the different chats from the different places. So we should be able to monitor everything, assuming stuff is working. That's always the key. So let's check over on the browser view. Okay, that seems to be working. Serena is still frozen. Let's see. Zoom is frozen on my side. All right. So yeah, that's okay though, because I had a couple things that I wanted to share before we even got into the Q&A. So I will start off on that part. Just telling Serena I'm going to restart Zoom. So let's close that. And yeah, eventually that'll work. Let's see, zoom. If I could just kill the process. End process. Okay. So then I'll let my computer catch up to OBS, and we can actually get this working. All right. Crypto Reaper saying audio cutting in and out now too on YouTube, off and on. Okay, so hopefully this will work. Maybe I'll just have Serena on Slack. Okay. So I'm just going to have her stay on Slack and monitor. And then... Okay, back now for audio clear. All right, so that's something. Let's see. Let's minimize that. I appreciate everybody's patience when dealing with the technical problems. All right. No. Okay. Red Moon. Well, this is the Tax Sherpa office hour, so we're not talking about moons today, or at least right now. In an hour, we're streaming Monster Mavericks, and we will talk about moons then. But for now, let's get into the chat. All right, so if you're new here, welcome. We're Tax Sherpa. I'm Neil. I'm the founder of Tax Sherpa. We'll get into some of these numbers in a minute here, but basically done a lot of taxes over a lot of years and saved people a ton of money. And I was actually thinking over the past little while about my own kind of origin story. So this part is just kind of like my brief journey into the tax world, and this first part is actually, I realize, the most important, and you'll see why here in just a second. But so I went to school not for accounting. I went to school for engineering. I was a ramblin' wreck at Georgia Tech, and got a degree in electrical engineering. So I went through kindergarten through 12th grade. Then I went to Georgia Tech for engineering, which was a very hard program. And right before my senior year, I was interning out in Texas with AMD, which is they make computer chips. That's Intel's main competitor. And so I was there in spring of 2000. So from January to May in 2000. And that happened to be the time during which AMD launched the first 1 gigahertz processor. And this was a big deal in the company because we beat Intel to the punch, and there was all kinds of fanfare, stock price shot up, everybody was super jazzed, all that was great. So it was a good time to be there, and I enjoyed my work there, actually. And then at the end of the spring term, they had a little award ceremony. I happened to be there still because the school term happened to line up with the time they held the ceremony, so I got to attend. And they were giving out awards, corporate awards, and they had, they're celebrating. One guy, he got 3 patents. Of course, all the patents belong to the company, but that's the deal you make when you sign up. And but let's give him a hand. He did a great job, and he gets a plaque, and we keep on going. So there were a bunch of these people that they were giving awards to, and I don't remember any of them except for the first guy who got the 3 patents and the last guy. So the last guy, I'll call Bob because I call everybody Bob, and Bob had a European vacation, a 2-week vacation booked with his family, and he ended up being needed by his team. I don't know what team he was on. I don't know if he was in sales or marketing or engineering or whatever. But so he has his vacation booked months ahead of time. The company, claims that they need his help, or I don't know if he volunteered or what. But anyway, he cancels his family vacation to Europe, and instead he comes into work for those couple of weeks. And it was crunch time, and isn't Bob such a great guy? He's a real company man. Let's give him a hand. And everybody's clapping, and they give him a plaque. And it was at that moment that I realized I can't do this. I'm not going to sacrifice my family vacation. And I was a 20-year-old kid, or maybe I was 21 by that point. I don't know. No, I was 20 actually. So I'm not. I was a single guy. I had a girlfriend, but no serious anything. And I realized that, in some future state, I'm going to have a family, and I'm not going to be, the good company man and give that up for, coming into work. So that was when I realized that this whole thing that I've been studying for years is not going to work out. And thus began my entrepreneurial journey. So, so my 20s were lots of ups and downs, mostly downs. Actually, I tried all different kinds of businesses, and I managed a bar. I did some SEO work. What else did I do? I actually had a job delivering lost luggage for people. So yeah, all kinds of things. and was making a go of it on my own in various different forms. And did real estate? That was a big one. Got crushed by the '08 crash in real estate. So, I had a lot of let's call it school of hard knocks kind of experience. And then in '07, I started getting letters from the IRS. I started getting letters saying that I owed them $1.3 million. So that was not possible as far as I was concerned. Now, I knew I hadn't filed my tax returns because I had lost money as far as I was concerned over the various years, and then I thought at the time that that meant I didn't need to file anything. Turns out that's not true. So what happened was I started getting letters, and then if you've never been through this process, here's what happens. You get letters, you ignore those. You start getting certified mail letters, and that takes probably like 8 months to a year. And if you ignore the certified letters, you start getting phone calls. And I got phone calls from this lady named Joyce, and she was the revenue agent assigned to my case. And I talked to her once. I said, this is just not real. There's no way I owe this kind of money. And, I forget what she said, but I ignored the phone calls from then on. And if you if you keep going down this road, what ends up happening is they will start going after whatever they can find. And they start garnishing bank accounts and paychecks. And by this point, so it started in '07, but this took till like 2009 or 10 that they started garnishing paycheck because I was working at that point. And that really got my attention. So I started to search around for how to fix my problem. And I ended up meeting up with this former Wall Street tax attorney. And I still is, I'm still, great friends with him. He's a fantastic tax planner. And he helped me fix my problems, and I didn't pay, so the garnishment they took, but I didn't pay 1 cent besides the garnishment. As it turned out, the money that I had paid was past the statute of limitations to reclaim, so I was kind of stuck with that, just because I had ignored it for so long. So I ended up paying zero of that, but then, I got introduced to this whole tax world. So, I'd been in the investment and financial kind of stuff. I'd been trading on my own and doing options and all kinds of stuff. But it was my first real introduction to high-level tax planning. So I ended up working with him, and so he was great at taxes, terrible at running business. I had picked up some business skills through these basically 10 years of wandering in the desert. And I said, well, I can bring in some systems knowledge and business savvy, and you have the tax piece, and together we can make something of this work. So we did that. In the next couple of years, we tripled his business, and I ended up working there for almost 10 years. So it was a very high volume kind of shop. So I ended up working since 2011. I've worked on over 50,000 tax returns, billions of dollars worth of revenue, and saving clients millions of dollars a year. So that was kind of my whole upbringing in the tax world. Very non-standard compared to most people in the tax world. So didn't major in accounting, majored in engineering. Went through a very old school kind of apprenticeship model rather than book learning. So there were times where I would, I'd be done with my work for the day and he'd still be with clients. I would literally stand behind his desk and just watch him enter stuff in the computer and how he interacted with clients. And what I didn't know at the time was that this was actually really unusual in terms of how I was getting my education here. And, when you think of, there's that phrase about how, you have to put 10,000 hours into something to become an expert. It's like, well, I was working 100-hour weeks, and I did that for 10 years straight. So, I've got well beyond my 10,000 hours. So, the tax world is separated into kind of two camps. The much larger camp is the tax prep world, and this is where you have your papers. You take them to your tax guy at the end of the year, and you say, "Here you go." They put it in the computer and say, "Here you go. You owe this, or you get a refund of that, and let's sign here and pay me." So that's tax preparation, and I don't want to. I hesitate to bash people too much because the tax prep world, or the tax prep side of things, is important. It does have to be done. It has to be done right, and but there's not a whole lot of value you're creating for your client in that scenario, because you're reacting after the fact. So the way I was trained and the way I have developed over the past 12, 13 years was to actually figure out what it is that we can do in order to help our clients, and put things in place, enact strategies, and save tons of money. So that's where I come from. And when I founded Tax Sherpa, our real main focus is on the people in the middle. So if you're just a W-2 earner and that's the only thing you have going on, there are some things we can do for you, but we are limited. We are hamstrung a little bit by that W-2 because the current Withholding Act is left over from World War II. They get you up front. So there's a limit as far as how much we can claw back from the money they've already taken from you. Now, so at the low end, if you're a W-2 only, then you go to your corner tax person and you hand over your forms, and that's kind of it. Yeah, I mean, there's basic stuff you could do. You can do retirement strategies. You can put in money into an HSA, stuff like that. But especially since the Trump tax reform, the amount of planning opportunities on the individual side are much more limited. Those may be coming back in 2026, but we've still got a few years to go before the Tax Cut and Jobs Act, a lot of those provisions expire. So, on the high end, if you're a big business, there's large firms out there that charge giant amounts of fees, and I've seen quotes for doing a tax return for $150,000. That's not including the books. It's not the information going into the tax return. That's just filling out the form. And there are firms who pay that. So more power to them. I'm in these private accounting mastermind type groups, and they're always stressing like, well, you got to go after the high fees. You got to serve higher end clients and all this kind of stuff. And it's like, yeah, okay, but that's not my people. My people are the same people like me who are unemployable. Just because we're not going to fit into the corporate world, and we're not on, we don't have huge businesses. So it's those people in the middle that are really our tribe. So if you're a solopreneur, a 1099 contractor, you have a small business, maybe you have a few employees, but you're in that middle bracket. You can't afford those giant fees because it doesn't make any sense. And you go to the corner tax prep place, and they'll put your forms in the computer, hopefully accurately. But there's no planning, because there's so much opportunity in once you're a business owner of some sort, that you're just crazy for not taking advantage of it. So those people end up getting screwed, and our whole mission is to stop that and to keep that money in your pocket. So the fact that I realized the corporate world was not for me is really what has led me to founding Tax Sherpa and serving clients that we do. So. Well, enough blathering on. Let's jump into some stuff. The questions. So this is office hours. So every other week we do this office hours where we just answer open questions, and interspersed with that we have just here's some solid strategy and content. So next week we'll be doing our 4-step process, and this is basically how we turn if you're earning $100,000 as a contractor, we'll show you how to save over $18,000 in taxes just by implementing 4 key strategies, and without changing how much you make and without changing how much you spend. Just by structure and strategy implementation will save you, $18,000 on that scenario. So without too much further ado, let's get into the questions. But first, I have my own question. So I hired some consultants, and they were trying to get me to refine my thinking a little bit. And they asked me this. So what is the root problem with overpaying on your taxes? Because, you can. I don't want you to, but you can. But what's really the problem? I mean, nobody wants to overpay. Or if you do, if you think the government's doing a good job with your tax funds, then you're probably not going to get along with us. So if that's you, you're probably not in this audience. However, overpaying is just money, right? But when I think about this question, I was like, no, it's not just money, because what it really is you're wasting 20 to 40% of your life, and that just stabs me to the heart. So, and what do I mean by that? So if you're overpaying your taxes, it depends on your situation. Everybody's numbers are different, but 20% to 40% is actually a pretty normal range of tax load on a given amount of income for typical kind of people, especially in the solopreneur, small business, contractor type world. So you got to take into account all the taxes. There's income tax, there's federal income tax, there's state income tax, there's payroll taxes, which is Social Security and Medicare. There's net investment income taxes. There's capital gains taxes. There's all these things, and they add up. And sales tax also, but you're kind of stuck with that depending on where you live. So all that time that you spent working, generating that income, is going to, I would argue, bad purposes. And how much of your day? So let's say you work a full year. It's 250 working days, more or less. If you're paying 20% of that to taxes, that's 50 days, 50 working days that you're paying, that you're working for, not yourself, not for your family, not for going off on vacation, not for just gambling with because I think going to Vegas and just blowing all your money is still a better use than paying taxes. Not investing for your future, not reinvesting in your business, not doing ad spend, not anything, just working for the government. And that's just when I thought about this, that just made me really take a step back and say, what we really do is we help you get 20 to 40% of your life back. And how much better are people's lives when they have that time to themselves? Maybe you don't spend it working. I don't know. It's up to you what you do with that. But maybe you spend more time with your spouse. Maybe you go on vacations. Maybe you do work and you reinvest that time and grow your business bigger and better. I don't know. It's completely up to you. But I'm on a mission to help everybody save that 20 to 40% of their lives and get that back. So that's my question and my own answer. I hope that's not too esoteric for you, but let's jump into the other questions. So I have the answer to every tax question, and it depends. So I find myself saying this all the time, so I have embraced it. It depends because everything's facts and circumstances. Last office hours we talked about the 1099K issue. So if you haven't heard this, there's a new rule for 2023. It was actually supposed to start in 22, but they delayed it. So in 2023, if you got money through a payment processor like Venmo or PayPal or Airbnb or Zelle or any of those, there were old rules where very few people got 1099 reports out of that. And the new rules that if you got any number of transactions where the total exceeds $600 for the year, you're getting a 1099K. So you'll get a copy and the government will get a copy. And the latest estimate that I've seen is that this is going to generate a new 30 million tax forms that are going to be filed by these payment processing companies. So the problem with this is that if you get $100 from Venmo and deposit it into your bank account, is that income? Is that taxable? Well, it depends. It depends on what it was for. Is it a loan? Is it a gift? Is it a repayment for something? Maybe you went out to dinner and your buddy is sending you $100 for their half. Or is it income? So like I pay my lawn guy on Venmo. That's definitely income. I pay my daughter's music teacher on Venmo. That's definitely income. I pay another daughter's Girl Scout fees on Venmo. That's not income because that's there's no business activity there. So it all depends. It's all facts and circumstances. So that's the real answer to every one of your tax questions. But I know people want something a little bit more specific than that. So we're gonna jump in, and I've got Serena here on Slack still, so normally she would be on Zoom, but my computer was breaking. Let's see. If you need to, you can just log yourself in. Yeah, so I'm just going to tell her, just Read me a question. We won't try to fix this on the fly. I'll have it set up better for next time. But let's see if I can get here. Go to Restream chat. Oh, there's nothing on. Thank you for patience. So we're streaming on one side, but not on the other. That is super interesting. Let's go to here. Live. Okay, so question number 1. Can you write off a Lambo if you use a studio prop for any marketing purpose? So this is a fun one. The Lambos. It depends, right? So cars have some unique rules when it comes to them. So Lambo, is an expensive car, and you run into certain issues. So most people have heard of the over 6,000 pound thing, and that gets into section 179, where if you have what they consider a commercial vehicle, which is 6,000 pounds or over, they're thinking trucks and vans and buses and that kind of thing. Then you could write off up to 100% of it in the first year. Now there's caveats with that. So caveats are that it can't be a luxury vehicle. Caveat is that you have to have the income in order to absorb that loss. So one of the things about section 179 is that you can't generate a loss with it. So let's say you buy a $150,000 vehicle that's over 6,000 pounds, a dump truck, let's say. If you don't have $150,000 of income, then you don't get the full deduction because you can't go negative with 179. So you can go negative with bonus depreciation, but bonus depreciation is changing. So 2022 was 100%, and now it's stepping down by 20% a year. So we're getting 80, then 60, then 40 over the next couple of years. So that's one issue with bonus depreciation. But also, you got to be careful with the luxury vehicles. So the normal answer would be, well, if you buy a vehicle in a company that is over over $20,000, but over $100,000 really, then you get limited. So you can take a $20,000 first year deduction, and then you kind of depreciate a bunch over 5 years. But there's caps on each one of those years. So that's kind of the normal advice. You can do it, but you won't be able to get the full deduction and all that stuff. So here's one of those situations where we have a workaround in that what can we do, right? So what we can do is we can actually, you don't buy it in the company because then you're limited by all these rules. You buy it personally, and then you have to depreciate it over its lifetime, which for cars is 5 years. But then you can take reimbursements from an accountable plan, and that does not have those limits attached to it. So you would take, let's say it's a $150,000 car, then you would figure out whatever the business percentage of it is, and that's going to depend on the facts and circumstances of what it is you're doing. And you would apply that to the purchase price and then take, a straight line depreciation of that. So 20% of whatever that is each year. So that is the way you would do it. Now, with that said, any business deduction, whether it's a car or anything else, has to be what's called ordinary necessary, or sometimes you'll hear it the other way, necessary and ordinary. So necessary meaning that I need this for my business. Now, every business is different, right? So this says studio prop, and that implies some kind of, broadcasting or streaming or YouTube or whatever. So is that necessary? And if it's a marketing asset, then maybe. You would have to look at what it is the business is actually doing. Does this make sense in terms of, will this generate more money? That's always the real question when it comes to substantiation. It's like, are you doing a business activity just for just for tax purposes, or are you doing it because it will, you know, the intent is to increase the value of your business? Because really, the code is written in such a way that the that they're trying to incentivize a business development. So, you know, if you are doing things in business and you're trying to generate more money and grow the economic activity of the country, that's what you get incentivized for. So that's really the key framework to keep in mind, as far as like, is this a necessary expense? Not that, you know, 1,000 people would agree it's necessary, but is it necessary to you in order to generate more business? That's the way you want to think about it. And then ordinary. So ordinary is a little trickier. So ordinary means this is not an exotic thing that only you would agree with. You gotta take that personal viewpoint and balance it out with the fact that other people in your business, in your niche, do this kind of thing. So is it ordinary in that sense? So like if you are a YouTuber, so what was the guy's name? Ty Lopez? Was that the guy? Like, welcome to my garage and here's my Lambo. You know, Andrew Tate talks about. I've actually never seen any Andrew Tate content, but I'm told from other people posting about stuff. He says, "What color is my Bugatti? Or what color is your Bugatti?" I don't know. But you know, so this affluence marketing kind of thing is a thing that is done out in the business world in that niche. So if you are somewhere, you know, close to that, then you could certainly make a case that it is actually ordinary. So that's how you would do it. You would you know, sidestep the corporate limitations on cars, do it on the personal side, figure out the business use percentage, and then take depreciation reimbursements from there. So you know, there's a lot of T's to cross and I's to dot in that strategy, but that's the basics of how you would do it. All right, we got another question coming through. So let's see. How does cost segregation help property owners and investors, and what types of properties qualify for this strategy? So yeah, cost segregation is great most of the time, as long as it applies. So cost segregation, if you've never heard the term before, is a real estate strategy. So what it does is it segregates costs. I mean, that might sound obvious. So let's say you buy a building, okay? Let's say it's a warehouse. So there's not much going on inside. It's just a big shell of a building, and you buy the building and the lot that it's on. So let's just use round numbers, $1 million. Okay, so in a normal approach to real estate depreciation, you know, you can't deduct the whole $1 million. That's just not kosher. What you can do is you can depreciate the parts that wear down over time. So in commercial property, the timeline for doing that is 39 years. So you have to separate out the land from the improvements, because land doesn't depreciate. So let's just say, again, round numbers, we'll say that it's $200,000 of land and $800,000 of building, of, you know, improvements. So okay, so now we got $800,000 spread out over 39 years. That's pretty close to $20-something thousand a year. So your depreciation expense for each year would be 22,000, something like that, 23,000 maybe. And that's just taking the building all as one thing. But a building is not all one thing. So, you know, cost segregation is where you hire an engineering firm and they come in and they separate out all the different things. Say, okay, this much is structure, this much is flooring, this much is lighting, this much is wiring, this much is cabinetry, this much is, you know, lot improvements, you know, for landscaping and driveways and sidewalks and all that kind of stuff. And they'll break it all out. And each of those things that are not structural have shorter depreciation lifetimes. So they'll either have 5-year, 7-year, or 15-year lifetimes. So the shorter the time span that you're depreciating over, the higher the percentage you're taking each year. And so what ends up happening is, ballpark average, about 20% of the building or the non-land cost gets segregated into these shorter term properties. And so if we have $200,000 in land, $800,000 in improvements, about 20% of that 800,000 is going to be the short-term property. So 20% of 800,000 is 160,000. So we're going to have 200,000 land, 160,000 shorter lifetime property, and 640,000 of structure. So the 640 is going to still be 39 years, but now instead of 23,000, we're down to 19,000 or something like that of depreciation each year. But those shorter term properties, because of the bonus depreciation created in the Tax Cut and Jobs Act, then the bonus depreciation that we can take on those 5-year, 7-year, and 15-year properties, you can take at least the majority of now in year one. So out of that $160,000 of short-term property, you might get, I don't know, let's call it 8 times. I'm going to have to open a calculator. Let's say 160,000 times 80%. So you might 130 grand worth of depreciation expense this year. So in year one, and so the power of that can be incredible if the situation is right. So before we had $800,000 going out over 39 years. That was 20,512 of deductions that we got from purchasing. We're going to have whatever we're going to have whatever revenue coming in, and then we're going to have our operating expenses, and then there's going to be hopefully positive cash flow left at the end. That positive cash flow is reduced on a tax basis by the depreciation. So under the pre-segregated scenario, that cash flow is reduced by $20,000 in year one. Under the cost segregated scenario, you get $130,000 of deduction in year one, and then you get 640 divided by 39. You get $16,000 in years 2 through 39. So that by shifting that long stream of let's call it $4,000 a year and bringing it all up front, then that really allows you to maximize your tax deductions up front. And time value of money now is going to always be better than money later. So you are exploiting the timing differences in order to maximize your deductions now. So that's what cost segregation is. Now, I know we're going long. So what types of, how does it help? So it helps by reducing taxable income. That's how it helps. So if you're an active real estate person, like a real estate professional, then you can get rental property, which normally when you have rental property, you have what's called a passive activity loss limitation, which limits you to a maximum of $25,000 of deductions in any 1 year. And if you're over $150,000 worth of income, that passive limit is 0. Or if you're married filing separate, the passive limit is 0. So if you are, if you're in any of those scenarios, then you're not able to make full use of those real estate losses. So if you're passive and or your income is too high, then the cost segregation is not going to help you. So that's a critical thing to keep in mind. But if you are active, and active has a couple different definitions, but the easiest one is for professional, where you have 750 hours of time in real estate activities, and there's an election you have to make in order to treat multiple activities as one for the purposes of this test. And so 750 hours, and at least 50% of your time is spent doing real estate stuff. So the 50% is where people get tripped up. Because if you have a day job, I was talking to somebody on Friday who was in this situation. It's like, well, he's got a day job. He spends a lot of time. He spends the 750 hours, but it's hard to make an argument that he's spending 50% of his time because he's got this high-paying W-2. So, we talked about it and went through kind of his specifics. And it was like, well, we're probably not going to satisfy this test. And the way you know for sure is whether you satisfy this test or not is you keep logs. So you just keep track of your time spent doing all the things. So, spent so much time at the day job, and I spent, so like today, I actually did some real estate training myself. I spent a couple hours on a seminar talking about pre-foreclosure note buying, which is an interesting area. And the and so you got to figure out whether cost segregation is going to do anything for you, and it's going to depend on your circumstances, because you don't want to these engineering studies, they cost money. At the lowest I've seen is about $400, and that's for a very small property, and they can go up to $5, $10, $20,000. Just depends on which what kind of property you have and how complex it is and what the value is and all that kind of stuff. So first you got to make sure that cost segregation is going to do something for you, and if it will, then great. Then you proceed. And what kinds of properties qualify for the strategy? Any kind of strategy, any kind of property that is rental. So it can be a residential rental, it could be a commercial rental, it could be multifamily, it could be storage, it could be all kinds of things. But it can't be a primary residence, it can't be a place where you live, and it's got to be rented out. So if you're doing like flipping, then cost segregation doesn't really apply. It's because you're not depreciating anything. Because in flipping, your housing costs are inventory. It's not the same thing as depreciable property held for the long term. So that is cost segregation and how it helps owners and investors and what types of properties. So let's see. Any tips or required documents for claiming cost segregation deductions, especially in case of audit? Yeah, so you need to have an engineering study done. That's what you got to do. So you hire these firms, and like I said, they charge $500 to $20,000, kind of depending. And they'll give you a formal report, and this is their official engineering opinion, and that's your backup for those purposes. I personally have not seen a cost segregation study challenged, but it could happen. What I have seen challenged is if you meet the active criteria. So that's where a lot of people get caught up because they're not keeping logs like they should. Another question. What happens tax-wise if the insurance payout is more than the property's original cost? Any strategies to handle this situation? So yeah, this actually came up recently. So this is a very unusual situation where normally when you have an insurance claim, they're gonna cap you at however much the property cost. So normally this is not so much of an issue. But what happens is if you have a really good insurance policy, or you have had a piece of property for a long time, what happens is you got to compare the insurance payout. So let's just say there's a property, it burns to the ground, and there's no residual value. Okay, so just we had something that was worth something, now it's worth zero, and then we got some money from the insurance company. So what happens? So what you have to do is you have to compare the insurance proceeds against the tax basis of that property. So the if the insurance proceeds are greater than the tax basis, and basis means that acquisition and investment minus depreciation we've taken. So it depends on where in the timeline we are, whether we did cost segregation, all those kinds of things. So it depends on that as far as how much tax basis you have left that is carried on the books. So again, let's just do round numbers. Let's say you bought a place for $1 million. It's a commercial warehouse, and you've held it for, I don't know, let's say you've held it for 5 years, right? So we did cost segregation too. So we'll use the same numbers from our cost seg example. So we took 130 up front, and then we were depreciating an additional 16,000 each year, and we've held it for 10 years. So 16,000 times 10 is 164 plus 130,000 that we took up front. So we have depreciated $294,000. Now, the $200,000 of land, that's going to stay the same, but we had 800,000 of improvements. So 800,000 minus 294,000 sounds pretty close to 500,000. So yes, that leaves with 506 of tax basis. So that's how much value is left in the tax basis as far as things we haven't written off yet. So now the insurance money comes in, and let's say they they say, okay, the property is worth 800,000, then and they pay you 800,000. Now we have a difference. We have a positive gap between the insurance proceeds and the tax basis. So that difference is actually considered a capital gain. So it's just like selling a stock. So if you have 294,000 of excess insurance payouts, that's going to be treated as a capital gain, as though you sold $294,000 of profit in stock. So whether it's long term or short term is going to matter. But yeah, that can be a tricky situation. Fortunately it's not common. Not that many places burn down or get condemned or whatever, but it does happen from time to time. We got another question here. How does making money in another country affect my U.S. taxes, and what rules should I be aware of? Okay, so this is one of those questions that's different in the U.S. than everywhere else. So the U.S. Has what they call a worldwide income regime, meaning that the U.S. government requires you to pay taxes on the on your worldwide income. So that's the that's the thing to keep in mind. You have to declare income from all sources and all geographies. So if you made money in Cambodia, if you made money in Australia, if you made money in France, you have to report it all to the U.S. government, as long as you're a U.S. taxpayer. So this is why some people, especially super rich people, have expatriated and have given up their U.S. citizenship, basically because of tax reasons. So what happens is that foreign income gets reported here in the U.S., and then if you paid tax on that income in those other places, then you tell the U.S. government, say, hey, I've already paid on this. I paid such and such to this government over here based on this exchange rate and all that kind of stuff. That goes onto your Form 1116. 1116 is the form, and then they apply a credit for the taxes that you paid. Now, you got to watch out for that credit, though, because it's not always one-to-one. It depends on how much money you make, because they'll phase you out. We had one client who was a soccer player, played in the big leagues, and he played in England. He was in, well, I'm not going to get into the specifics, but he was from South Florida, got drafted into the leagues in England, and so he paid a ton of taxes to the UK, and UK taxes are higher than they are in the US. So normally, in a normal income kind of range, then that means you don't owe any income or don't owe any tax on that income in the US, because you've already paid more than enough to the UK, and the government says, okay, we're cool, you already paid on that. In his case, he made so much money that he was in a phase-out regime where they didn't give him full credit for the taxes that he paid. So he still ended up having to pay more tax to the U.S., not the full amount, but some, on that income to the U.S. government. So that's definitely a thing to watch out for if you are a high-income earner. And generally, you want to avoid those cases and structure things so that you don't get hit in the same ways. But that gets into international tax planning, which is if you want to spend some money on some lawyers, that's a place to do it. What happens? Oh no, we already went over that one with insurance. How does making money in another country? Oh no, we got that. So the other side of making money in another country, if you are physically present in that other country, then it's another different thing. So there is this thing called the Foreign Earned Income Exclusion, which is Form 2555. So what that is they'll give you a break, basically. So if you are out of the country, and there's two different tests. So one is a bona fide residence test, and the other is a physical presence test. So the easier one is the physical presence. So if you're out of the U.S. for 330 days or more during the year, the calendar year, then you are considered to be outside the U.S. So you can only spend 30 days inside the U.S. Bona fide is a little bit more complicated, where you've declared yourself a tax resident of this other place, and you've gone through the government processes in that other place in order to establish yourself as a tax resident. But whichever test you satisfy, you still have to report your income to the U.S. government because you're still a U.S. taxpayer, but they will give you a break on up to about $110,000 worth of income tax. not sorry, a worth of earnings towards income tax. So let's say you're on assignment. This happened with a client a number of years ago. They were on assignment to Australia, and they were still working for a U.S. company, and they were earning it was 100 plus. I think it was like 180. And so what happens is that 180 comes in as a W-2, and that normally that's just regular taxable income, but he got an exclusion for, back then it was 106,000. So he had an exclusion for 106, and that left him with 74,000 worth of taxable income for income tax purposes. Now the thing to keep in mind is that this only applies to earned income. Okay, so some people get tripped up on this, where the earned income for tax purposes, at least in the U.S., means you paid Social Security and Medicare on it. So payroll taxes were applied. So if you have non-earned income, like from an investment property or from an S corporation or something like that, you're already getting a tax break because you didn't pay payroll tax on that money. So you don't get a double tax break on the income tax side of it because of that. So you have to have paid, or the only funds that apply for this earned income exclusion is money that you have paid payroll tax on. So there's two different versions of payroll tax. So one is through a W-2, Social Security and Medicare tax, or if you are self-employed, then self-employment tax. So how much of your earnings was subject to those things, and then that is eligible for the foreign earned income exclusion, up to the various limits, assuming you satisfy the various tests. So that's something to keep in mind with foreign tax strategy. Let's see, what else we got here? And we are coming up on the end. Oh, we do have a hard break at 7 o'clock, so we got about 8 minutes left. Are there any credits that can reduce my U.S. taxes for the foreign taxes I pay? How does that work? Okay, so that's actually what I was talking about before with the Form 1116. So that's your foreign taxes credits, foreign tax credit. And there's, like everything else, there's lots of caveats and things that go along with that. So that is something to keep in mind. And the one thing that does surprise some people is that if you paid, so let's say you have two sources of income. You have foreign derived income. Actually, I'm not even going to get into FDII, but there's FDII. There's also GILTI, but that's more complicated than I'm going to get into right now. But let's just say you had a job in. We had one guy who was a realtor in London for a while, and so he got wages from there. Let's say $100,000. He paid 40% of that to the crown, as they say, and his tax rate here in the U.S. would only be 20% of that. Let's say, so he paid 20% extra to the UK. Now, if he has other income from the U.S., let's say he's got $50,000, that extra tax that he paid to the UK does not cover the non-UK income. So you don't get to apply that extra credit to the domestic earnings. So which might seem unfair, but that's because it is. But those are the rules, and that's kind of where you have to watch out, because you might think, oh, I pay all these taxes, and you did, but you only get credit for a portion of them, and only the directly related stuff. So that's something to keep in mind. But that's how it works. You file your Form 1116 and attach it to your tax return. What are the rules for reporting foreign assets, and what happens if I don't follow them? Whew. So this gets into what are called FBARs. So there's two different sets of rules for FBARs. So first set of rules is if you have a bank account that you have either ownership, whether it's direct or indirect, or if you have signature authority. So signature authority trips up people sometimes, where if you have, you might work for a big company that has a foreign division, and you're able to sign checks out of this account in Germany or whatever, that counts because you theoretically could write yourself a check and abscond with some money. So, if any of those accounts, if the totals of all those accounts, maybe you have one, maybe you have 100, who knows, the totals on any one day exceed $10,000, then you have to report those accounts to the Department of Justice through FinCEN. And there's a form you got to file every year. It's called the FBAR. They've actually updated it recently. Now they call it Form 114. But you got to file that. I think it's by May every year, but people get an automatic extension. So that's one set of rules. The second set of rules is that if you have the same type of accounts that exceed $50,000 of collective balance on any one day, then there's an additional form that you have to file with the IRS as part of your tax return, and that is form number 88 something. I can't remember what the other. Still live, but I don't see any. Oh, there it goes. Okay. Um, so that's what you do. That's you report your foreign assets. So it's not all assets. It's bank accounts and other accounts like that. Um, Property is exempt from this kind of reporting. So if you own a house in Spain, that's not a bank account type asset. So you don't have to report that. As of last update, which was several years ago at this point, cryptocurrency is considered property still. So that is actually not reportable under the FBAR rules. If you have gold in a safe deposit box in the Perth Mint, that's not a reportable asset under that regime. So definitely report the things that are reportable, and you can ignore the things that are not reportable. So that's something to keep in mind. And what happens if I don't follow them? If you don't follow them and they find out, huge penalties. It's like 50% of the value kind of penalties. So it's a big deal. So follow the rules. That's it's. So here's the dirty little secret. People used to think, and it used to be true, that it's like, well, I could put money in Switzerland, and I can evade taxes, or not even evade taxes, but just say hide all my stuff from the government. So if I ever get into trouble later, I have a hidey hole to go to. That doesn't work anymore. That's the basic idea. So there's this concept of what they call tax harmonization, where all the governments talk to each other. So if you have an account in France, France talks to the U.S. and they say, yeah, we have accounts under this guy's name and social security number. It has this much in it. So do the reporting that you're supposed to do. There's only a few countries that have exceptions to that are willing to tell off the U.S. government, and so it's very few. And just don't